Welcome to Unlock Your Passive Lifestyle. Guys, today we are jumping straight into it. One of the most powerful and misunderstood tools in real estate investing, the 1031 exchange. If you own investment real estate or you're thinking about selling a property, this episode could literally save you hundreds of thousands of dollars. My name's Tommy Thompson, sitting here with Justin Kiehne.
Yes, sir.
And we're just going to jump straight into it. I mean, most people don't realize how expensive it can be if they sell an investment property and they don't know about the 1031 exchange. And I mean, just the basics around the 1031, right, Justin? Maybe we should just start with the basics.
Yeah.
Section 1031 has been around as a part of the tax code for over 100 years.
I think 1921, something like that, was the first like-kind exchange, and really just a way to defer capital gains tax liability on the sale of investment, commercial, business real estate. I mean, and you said hundreds of thousands. I mean, we've seen exchanges that defer millions, tens of millions of dollars in taxes that would otherwise be owed. So incredibly powerful. But you don't have to be a seven-figure real estate investor to take advantage of this. I mean, $200,000, $300,000 rental property, condo, et cetera. I mean, this is really a strategy for the people, right?
Yeah. And I mean, most people don't even know about it. That's the crazy part. And, a lot of CPAs don't know about it, either. But, just the basics, it's, no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment. If you exchange that for the same kind of definition, for property held for productive use in a trade or business or for investment, I mean, pretty much what that means in a nutshell, right, is no gain's going to be recognized if you exchange one investment property for another investment property.
That rolled off the tongue pretty nicely. You got that memorized, clearly. Yeah, you've said that before.
Yeah, but, if you're considering selling a property, an investment property, and you bought it and that property has gone up in value, significantly, that's hard-earned equity that you have in that deal, right? Maybe you bought a property for $1 million, 10 years ago, and now it's worth $2 million, right? It doubled in value. If you were to sell that and not do a 1031, you could owe 15, 20% just federal capital gains, and it could be substantially more if you factor in, what state you're in. If you're selling out of California or New York, it's going to be higher as well with the state taxes. But, that could be 20, 30% haircut.
So let's break that down specifically, right? That the numbers that you threw out, purchase for $1 million, appreciated to $2 million, in a sale of that property, right? 20% of that is $200,000, right? That's federal capital gains tax rate is 20%. California, I think, has the highest state income capital gains taxes, another 13% on top of that, right? Oh. You're looking at, to your point, 33, 35, 37% on $1 million, $300,000, $350,000, $400,000 of your money, to your point, hard-earned equity and appreciation gone to Uncle Sam. So using the 1031 exchange, right? Selling the property, following the rules, following the timelines, reinvesting in like-kind, you referenced it, and there's a definition there, but like-kind real estate, keeping that $350,000 in your pocket, so to speak, working for you. Real estate's all about cash flow, cap rates, right?
Sure.
5%, 6%, 7% cap rates. So if you talk about keeping $300,000 working for you on a 5% cap rate, that's an extra $15,000 a year in income to you, as opposed to, paying Uncle Sam and seeing your income take a hit, seeing your net worth, your equity take a hit.
Yeah, and I mean, we're using like the example $1 million, right? Yeah. And 20% on $1 million is $200,000.
Right.
That's crazy. If you just add zeros to that,
right.
$10 million,
orders of magnitude,
whatever
right?
it is. I mean, those numbers really add up, and we always add in the caveat, right? Where it's okay on the first call when we're having a call with somebody, we're like, all right, you own this property, you're planning on selling it, you're prepping it for sale, you've kind of done some napkin math. Talk to your CPA, right? We're not here to give you tax or legal advice. Everybody's tax situation is unique to them. So one of the first things we always say is, have you talked to your CPA?
Yeah.
What's the tax bill going to be if you don't do a 1031?
Right. How does this work for you? Specifically, what is your motivating factor? Because there are people that come to us sometimes and they think they need to do an exchange just because they're selling property. And sometimes it doesn't make sense. Sometimes they don't have substantial tax liability, right? Sometimes, it's not needed. So that is always the first question. But so then we've talked a little bit about some of the numbers. So talk then about the rules, right? So you mentioned selling investment property, reinvesting, so selling and then buying. But talk through the process there, assuming that some folks that are listening maybe don't know.
Yeah. So, let's just say you own an investment property and you're getting good offers on it, right? Maybe you're getting solicited and, you're looking at these numbers that you can sell your property for and you're going, wow, I'm going to have a pretty good heyday on this sale. The next thing you want to think through is, all right, well, how much in taxes am I going to owe? So if you go down the rabbit hole and decide, okay, I want to explore the 1031, or maybe I want to enter into a 1031 exchange, you want to prep prior to the sale.
Yep.
Because how many times do we get the call where it's like, hey, I want to do a 1031 now. And we're like, oh, when was your closing date? And they're like, yeah, I closed yesterday.
Last week.
If you take constructive receipt of the proceeds and they go into your Bank of America account, Wells Fargo account, or whatever, the exchange is dead, right? So you prep prior, you get a qualified intermediary in place. They're the ones that are going to hold the funds from the closing table. So let's say your closing is, whatever, November 1st, September, whatever date it is, your closing is 2:30 in the afternoon. That closing happens. The buyer's proceeds come in to buy the property. They get wired into the qualified intermediary's third-party escrow account. And in our industry, what do we say? The clock starts ticking.
Yep.
So from the closing date, you have 45 days to identify, not buy, what you want to purchase. On midnight of day 45, it doesn't matter if it's a federal holiday or anything, on midnight of day 45, that identification form is due to the qualified intermediary. And then whatever you have on that form, whatever legal addresses you have, those are set in stone. And you have 180 days from the closing date, or about 6 months, to close on one or a combination of those properties that you ID'd.
So closing is day 0, 45 days from closing to identify, right? And there are rules on identification that we can talk about.
Yep.
And then another 135 days to actually purchase your replacement property, right? So the 180 days total. And weekends and holidays count, right? In your identification period, they count. In your 180 days, they count. So end of the year is always sort of funny, right? Folks that are selling property in early December, and then right off in the sunset, and they spend time with family. Yeah, spend time with family over the holidays, and all of a sudden it's January 5th, and they're starting to dry out, and they're like, oh, wow, I only have a week left to identify my replacement properties. I guess I better get on that. Yeah.
Well, that's why we always say, before you close, we call it like the loading phase or the preparation phase. In a perfect world, if you want to sell your property, not pay and defer the taxes using the 1031 and go into another property, you kind of would want to know what you're going to go into prior to even closing on that first property.
Absolutely.
Because that 45 days, that goes so fast. That's just a little over a month. And like Justin was just saying, it's like, how many times do we have somebody, they close on their property, they enter into the exchange, and they go on vacation for like a week or two.
Yeah.
And, that doesn't leave you a lot of time because you got to do due diligence on the next property you're going to buy. Maybe there's inspections, appraisals, if you're getting a loan, all these things. So that 45 days, just like, it goes so fast.
Well, so residential contracts are, I think, pretty frequently 30 days, right? 30-day contract, 30-day to close. Commercial contracts, 45, 60, 90 days to close, right? So, if you make an offer and you go under contract on your replacement property on day 1 of your exchange, right? I mean, you're not closing on that replacement property until after the end of the ID period. So that leaves you exposed very much because, you see it all the time, right? I see it all the time. Just because you're under contract doesn't mean you're going to be able to purchase the property. You obviously hope to feel confident about it, but when it comes to sort of covering your bases, making sure you don't end up up a creek without a paddle, right? Unable to close, but past day 45, you always want to identify a couple of fallback options.
The parachute,
right?
We call it the parachute. Yeah.
Well, and there are 3 different rules as far as identifying goes, right? So talk about that.
The most common one is the 3 property rule. If you're kind of new to this, we usually tell people that's the easiest one to kind of understand out of the gate. So
most widely used, right?
Most widely used one, and it's really easy to put backups in place with that. So if you sell, you enter into the exchange, you have your 45-day ID period. The most common rule is the 3-property rule. What that means is you can put one property down as your first option. Maybe it's your favorite one. You can put a second property down. Doesn't matter the value, whatever. Second property down is your first backup.
Right.
And then you have that third slot because you can identify 3 properties. We call that third one your third favorite or your second backup or the parachute, right? So if you get past day 45, that deal that you loved, something happens, you know, the roof was bad or the seller stops communicating with you or whatever. All these things happen all the time. At least you have that second one to fall into. If that one falls out, at least you have that third one that you can fall into. Because, I mean, we're talking about really big tax bills that could be due here. And doing a 1031 really isn't even that expensive. I mean, what, it's like $2,000 or $3,000 maybe on the high end. And one of the things that a lot of people don't know is if you are kind of uncertain if you are going to do an exchange or not, if you just enter into the 1031, it extends your time clock 45 days. If you don't identify anything at the end of the 45-day period, you get your money back on like day 46.
No
right?
penalty, right? No harm, no foul. You know, you paid $2,000. You gave yourself an extra month and a half to kind of figure it out. No downside in my opinion. And I'll tell the horror story that I always tell when we talk about these identification rules, which is, client who sold a Marina for about $10 million with very low basis, right? So, $10 million sale price, pretty much all of that was taxable in one way or another. So, backing out some of the numbers that we threw around before, 20% federal is a $2 million tax liability, right? If you've got state income tax on top of that for another 5 or 10%, right? That's another $500,000 million in tax liability. Next thing you know, you're writing a check for, $2, $3, $4 million if you don't exchange. And in this case, they sold a Marina. They wanted to buy a Marina as a replacement property. During diligence, they realized that, hey, this property doesn't make sense. There were issues with the parking lot. It was on a lease to the municipality. And so, hey, we're unable to close. We're backing out of this deal. Well, the problem is that they were past day 45. They didn't have anything else identified, right? And so not only are they
it all the time.
Yeah, not only are they unable to close, but they didn't even get their money back until day 181, right? Because they had attempted to complete the exchange. So you're looking at 7 figures in tax liability, not to mention and we talk about this, uprooting their lives. Somebody had moved to another city to go run that Marina that they were now not buying. So that's worst case scenario, break glass in case of emergency. But we so frequently just tell folks, have a second choice, have a third choice.
It just kills us. Every time we get those calls, where they're like, hey, those DSTs don't sound so bad anymore. Because you can use the DSTs that we offer up as a really good parachute in those scenarios. And we get those calls and it's like, hey, what do you have on the menu? Oh, cool. Yeah, your 45th day. I thought that passed. Yeah. And they're on like day 47.
Right.
You can't change that form after that.
Right.
So they're free slots that you get to put, whatever property you want on there.
Mm-hmm.
And it's just there in case you need it. I mean, a lot of people don't even know. You were just alluding to it. You don't need to have it under contract, anything. I mean, you literally can throw spaghetti at a dartboard and put whatever. You don't want to do that. You want actual viable, backups in place. But we get those calls so many times, and it blows my mind. People identify one property, and they didn't use those 2 extra free slots.
Well, and so to that point, right, and you talked about kind of the loading phase in an exchange. So you're under contract to sell the property that you've owned forever, and it's anywhere from a few $100,000 rental property to a $50 million commercial property. And you've got this, very substantial tax bill that you're trying to defer. And you've got a closing date scheduled on your sale, right? And it's a month from now or 2 months from now. I always tell people, start looking, right? Figure out what you want to buy ahead of time. Your ideal scenario is that you close on your sale and inside of a week or two, you're now closing on your purchase, right, on your replacement. And that can be hard to do. It's hard to line up, right? A lot of moving parts. But when we're talking about DSTs and Delaware statutory trusts, right, fractional interests, in some of these investments, in some of these properties that qualify for the exchange, we do that a lot, right? We pick out a portfolio prior to a client's sale and exchange. So when they start their exchange, they're reinvested in the next property inside of a week.
Get their money working for them. Yeah, I mean, when you're working with really savvy people too, it's like they know how much money their money's not earning
Right.
every week or
Right.
every day or every hour that they're in that exchange account. So they want to get into that next property, right away. And the DST is great for that. And another thing that, we can go down a whole rabbit hole on this one, but this is like a huge one that a lot of people don't know is the debt, right?
Yeah.
So if you own an investment property or a commercial building or whatever, it's so common that people have debt because debt's one of the most powerful things you can tap into, right? So if you sell a property for $1 million and you had a $500,000 loan at the time of sale, want to talk to that?
Yeah, yeah, and that's that goes to the rules of the exchange, right? So using those numbers, $1 million sale, right? Let's say there's a $500,000 mortgage on that property. So there are 3 rules that you have to satisfy for a fully tax-deferred exchange, and the first is that you have to buy equal or greater. So if we sell for $1 million, we're buying for at least $1 million for fully tax-deferred exchange. It's equal or greater purchase price to sale price. The second thing is that we've got to reinvest all the equity. So $1 million sale, $500,000 in equity, $500,000 in debt. We've got to put all of that equity back to work, right? Not a situation where I sold for $1 million and I buy for $1 million and I take some cash off the table, right? That's going to be taxable.
Yep.
So for fully tax deferred, we're putting all the equity back to work. And then the third rule is that we have to replace any debt that was on the relinquished property at sale. So again, $1 million sale, 500 equity, 500 debt. We're obviously paying off the debt when we sell,
Yep.
right? But we're going to buy another $1 million property. We're not just investing the equity. We're also going to get a new mortgage, or if we've got some extra cash in hand or under the couch cushions or whatever, we can inject additional cash. But those are the 3 rules. So it's equal or greater to your sale price. It's reinvest all the equity and replace all the debt. And depending on what the debt markets are doing, that can be easier said than done, right? And one of the nice things about the DSTs that we work with, again, is that sometimes having that debt in place and be sort of turnkey for you can be a huge benefit.
Yeah, because it's really common. I mean, the IRS doesn't care how you do it, but what you sold for, you got to replace, right? So if you sold for $1 million, you don't have any debt, you got to replace $1 million. Whatever you don't replace, you'll just owe taxes on it, right? But if you have a mortgage or a loan on the property, you either have to get a new mortgage or, like Justin said, you have to inject cash, but you still have to replace that $1 million. They just don't care how you do it.
Yeah.
So that's a big one. And then another thing too, we kind of breezed over the beginning here. Another really common misconception is people get stuck on the like kind, definition in there. We get this a lot where people own a single family rental property that they've owned for 15 years or whatever, or a duplex, quadplex. And they think that like kind means you sell a single family rental property or an Airbnb property, you have to replace that into an SFR or an Airbnb. But it's just investment real estate for investment real estate. Right. So you can go from land that you held for investment purposes into a self-storage facility or self-storage in the multifamily. That's a really common thing. We get that question a lot. It's just investment real estate to investment real estate.
And it's, I see it a ton in rural parts of the country.
Yeah.
We're obviously here in Florida, though do business all over the country. Texas, the Midwest. We had a client a couple of years ago that had a family-owned property. It was agricultural. They ended up selling it for $20-25 million to a developer, and there were some siblings involved. So, kind of a fragmented 1031 exchange. But one of the gentlemen took his portion, his $6-7 million, and went out and bought mobile home parks.
Yeah.
Right. So agricultural land to mobile home parks, and I'm sure he's knife fighting his tenants, his residents every day. A little different than running a farm, but you can buy, anything so long as it's for business or investment use.
Yeah, and that brings us to, with the 1031, it's great for people that are, building equity, right? You're continually, pushing the can, kicking the can down the road. They call it swap till you drop, right? So for young investors that are getting in, you buy one property for 500, it goes to $1 million, you roll that into $1 million property. Now it goes to $2 million, you roll that, maybe you get some leverage, go into a $3 million property. And we have clients that have been doing 1031s for 30 plus years and never paid taxes on the sale. And then when you get to that type of client that is older, they might own what we call labor-intensive assets. Right. The duplexes, the quadplexes, the apartment buildings, all the tenants and everything calling you, texting you, whatever all the time. the 1031 is such a good legacy planning tool because at the end you can 1031 into, net lease, the Walgreens, the CVS's, the Dollar Generals, which, have long-term leases in place, or the DSTs. That's why we stay so busy, is because there's such a big need out there for people to, one, not pay taxes, two, want to be able to transition into something that's more passive. So it's either, hiring a management company and keeping the property, or selling and going into something like net lease, or selling and going into something like DSTs.
Well, and net lease historically, and we can talk about what specifically that is, and DSTs, and we can talk also, about specifically what that is. Those are truly passive in, real estate investments. But it can even be as simple as selling something that's a little bit older and buying something that's new construction, right? We see folks buy, new construction rental property because, everything's a little newer, fresher. The maintenance is a little bit easier, right? Hire a property manager. But no, historically, especially in the commercial side of things, people have, bought into DSTs or net lease properties. And your background obviously is in net lease. So talk a little bit about what those are.
Yeah, net lease is, it's a lot of the places that you drive by or you go to every day. A net lease property can be a Taco Bell, it could be a Wendy's, a McDonald's, it could be Hobby Lobby, it could be Best Buy, Walgreens, Home Depot. Those are all net lease properties where the tenant, Home Depot, for instance, publicly traded company, they'll sign a corporately backed guaranteed lease, maybe a 10-year lease, 15-year lease, where, they're on the hook for paying you rent, essentially, for occupying that space. And it's a really solid tenant to have in there. So you kind of have the security of knowing that they're going to pay their rent. The only thing that, we always bring up, and, you've heard me say this a million times, is like, it's great, but all of your eggs are in one basket. Right. And it's not cheap to buy a Home Depot. They're like $15-20 million. Even Walgreens have gotten so expensive over the years. I've seen a couple come out recently that were, $10 or $14 million, and Walgreens is going through some stuff right now. So that's what we encounter a lot is, okay, should I go into something that's net lease, have that big tenant kind of back in the lease there, or should I go into something like DSTs where I can kind of spread that out a little bit and not have all my eggs in one basket, just in case something goes wrong with a CVS or a Walgreens, which, did recently happen.
So speak to the net of the net lease, right? The lease structure versus like me renting an apartment.
Well,
right?
And it's really important that when you're looking at net lease, you have to work with a net lease broker. Yeah. You have to have an attorney that's looking through the leases, also the lease agreements. It can be really complicated.
Not all leases are created
equal. No. They want to try and get the best deal possible for themselves. But a true triple net lease or an NNN lease is going to be where you have zero landlord responsibility. Right. So the tenant, Home Depot or whoever it is, if the roof needs to be fixed, they fix the roof. If the parking lot needs to be fixed, they fix the parking lot. They pay the property taxes, the property insurance, everything, and they just pay you rent.
Right.
Where it gets really complex is when it's a double net lease and you're reading through the lease and you're going, wait a second, they don't want to be responsible for the roof.
Right.
And the roof on those buildings, even on a Walgreens, can be like so much money to replace, hundreds of thousands of dollars.
Seven figures, right? Yeah.
So you have to be careful on a true triple net lease. You're really passive in that scenario there. You obviously want to probably make sure they're taking good care of the real estate. But on a double net lease, you could be on the hook for a combination of those things, parking lot, roof, whatever, maybe property insurance, taxes, whatever it is. So you need to have an attorney look through those leases.
Sure. And historically, right, so folks are selling property for, a few $1 million. They're selling apartments, they're selling storage or whatever it is, and they're looking for cash flow, right? Yep. And so historically, those types of properties, those NNN, right, the triple net leases, the double net leases, sometimes get viewed kind of as bond-like, right? You've got a corporate guarantee, from a publicly traded company. That publicly traded company might have investment grade credit, right? And these leases are talked about sometimes in the same way that bonds are talked about, right? They talk about the credit rating of the person guaranteeing the payments, right? Person guaranteeing the lease. But certain types of properties and certain types of tenants are structured that way, right? You're not going to see an apartment building on a triple net lease, right? You're rarely, except in very specific instances, going to see self-storage properties on a triple net lease. Yep. And so, for folks that maybe want exposure to things that aren't just fast food restaurants or grocery stores, right? It's how do you get that same sort of economics and access, without having to manage it yourself, right? And that kind of enters the DST, which is, an apartment complex, a 300-unit apartment complex, a self-storage portfolio with a master lease where someone is operating it on your behalf as an investor, right?
Oh.
You're buying a fractional interest in a larger property. In one of these reputable private equity groups is the one that is boots on the ground. They've got property management, they're managing the asset. And so you get a little bit of those economics that sort of set it and forget it monthly cash flow without being limited, one, to fast food restaurants and pharmacies, right? And two, without having all of your eggs in one basket. Those purchase prices are much lower, right? Minimum on a DST investment's $100,000, $200,000.
When you wrap your head around that, it's so powerful, yeah.
So, you're doing a $2 million exchange, you can buy 5, 6, 10 DSTs versus a $2 million exchange where you might buy one single tenant net lease property where you've got this binary outcome, right? CVS goes out of business or they don't, right?
Yeah.
So you're exposed in a way, right?
Yeah, and DSTs are securities. They're for accredited investors only. And you could think about it like buying a slice of a pizza, right? I mean, it's an institutional asset, might cost $100 million to buy it. Maybe it's an Amazon distribution center, $100 million, purchase price. You can buy a slice of the pizza of a property like that for as little as $100,000 using your 1031 proceeds and become passive. And the big difference with, and I love net lease, I have a background in it, and I'm never going to talk bad about it because it's a great asset class. But when you really wrap your head around it, it's not as passive, because if you have a 15-year lease on something and you hold it for 10 years, you have 5 years left, maybe you hold it a couple years more, you have 2 or 3 years left, you have to renegotiate that lease with a publicly traded company, which is not easy to do.
Right.
So if you're looking to hand those properties off, to your heirs, you might be leaving them a bag that's like, are they really real estate people? Maybe your kids are like doctors, nurses, attorneys, school teachers or whatever, but they're not real estate people. For them, having to renegotiate a lease with like Taco Bell or Home Depot or Walgreens,
Starbucks,
that's not that easy to do.
Right.
So you got to know the people to talk to. You got to know the people to call, the attorneys to look through the leases and stuff for you. So net lease is great if you are kind of savvy in real estate.
Yeah.
But if you're looking for truly passive, the DST kind of, surpasses that a little bit, in my opinion.
I agree. And we talk about it, kind of, building a mutual fund of real estate in a way. You're getting exposure to multiple different types of real estate, multiple different markets, right? Because these minimums are lower, because we can, diversify different investment strategies, right? And you typically don't see that. That is another piece, right? You typically don't see in net lease real estate this sort of value add or value creation type investment strategy, right? You're buying it, and for the most of the folks that are buying it, they're kind of buying it, again, sort of like a bond. They're buying a stream of payments, right? Stream of future payments.
Yep.
When you're buying things like apartments or student housing or self-storage, right? The things that are, in these DSTs, in my opinion, there's a little bit more room for value creation, right? We can do some renovating of the apartment units. We can do some renovating of the student housing units. We can raise rents when leases turn over, when those leases come to an end. And when we raise rents on a property like that, we're forcing appreciation, right? We're not just kind of collecting this stream of payments. There's a little bit more operational sort of intensity to it, which is why, you like to work with a company that's been doing it for 20, 30, 50 years, right? And that's kind of, some of the companies that we're working with in the DST space.
Yep. And another really good piece to all this too is, that a lot of people don't know. And this will play into kind of, the next piece here too is the demographic shift that's happening right now, and why 1031s are so popular and will continue to be. But a lot of people don't know that if you own a business also, right, and that business owns the real estate,
right,
you can sell the business. Maybe it's an air conditioning company, a heating, plumbing company, whatever it is, CPA firm, law firm, whatever it is. If you own the real estate and the business and you want to sell, the business might be worth X, the real estate is worth Y. You can 1031 the real estate, not the business proceeds, just the real estate proceeds. So a follow-up to that is, what we talk about all the time is the demographic shift that's happening.
Right.
Baby boomers are retiring at, incredible rates. They're saying 10,000 people turn 65 years old every day as a part of that demo. And then you have like that undercurrent of the millennials coming in, the larger demographic that wants to buy real estate, roll up their own funds, start businesses, buy businesses, whatever. So you have one exiting and one entering. And the 1031 for those baby boomers, if they own a business or just investment real estate, is such a powerful tool to have in their back pocket.
Well, and we're talking to business owners that are exiting all the time. Just the nature of these conversations, the tax planning, the long-term kind of retirement planning and retirement investing. And you're selling a business. At the end of the day, you're selling your job, right? You're selling your income stream, right? And so, in those situations, these are business owners that bought property to operate their business. They're not necessarily real estate investors, right? The real estate has never really been an investment for them. It's been a means to an end, which is running their business. And so, they're not hands-on, right? When they sell that, the idea of investing that real estate portion passively is very appealing. Again, because it's not a headache, right? And it's not their skill set. But they're selling their stream of income. They're selling their business. So, how do we replace that? 1031 exchange can help. DSTs can help. Triple net real estate, if that's the way that they want to go, it can be that passive income. It can be that, a passive lifestyle, right?
Unlock your passive lifestyle. And, for the real estate brokers and business brokers and stuff out there that are listening, this is a great prospecting tool, right? And what we offer too, life after landlord, we say, unlock your passive lifestyle. You're going to encounter those owners that have owned a property or a business for a long period of time, and you get the call and they go, hey, Justin, I'd love to sell, but I don't know what I'm going to do. I'm going to have a huge tax bill. Having these replacement solutions on the back end to go, well, hey, Justin, Jim, whoever, Sally, you can sell,
right,
and we can 1031 exchange those proceeds into net lease or the DSTs that we offer. And you can have that life after landlord where you can boat more, golf more, whatever it is, spend time with the grandchildren or whatever. But, that demo, they want to retire. They don't want to pay taxes. So we get a lot of leads from real estate brokers going, I have an offer on this guy's property, but he won't take it because he's going to have such a large tax bill.
Yeah, and it's funny, right? You mentioned that time on the golf course, time with the grandkids. Buy an RV, travel the country, whatever your preferred, sort of retirement activity is. But the idea is, let's unload ourselves of responsibility and kind of enjoy the golden years. And then I would say that is the majority of the clients that we're working with in some of these passive, it's in the name, right? Your passive lifestyle, for those younger guys and gals that are in the wealth building phase, that 1031 exchange can still be a very powerful tool. And you mentioned it earlier, buy property, sell at a profit, use the exchange to buy bigger property, right? And rinse and repeat. And for those folks, it really is, it's kind of like a 401k or an IRA, right? It's letting the money grow tax deferred. And so it's interesting because it's, a section of the tax code that's been around for 100 years, and yet there are 100 different ways that it can be used. And we're talking very high level, right? We're talking about a forward exchange even, there's reverse exchanges and improvement exchanges, and seller financing and note carryback exchanges and all sorts of different things, right? And so it is. You can really get into the weeds and into the nuance, and it's just a very powerful tool. It's cool and it's interesting because every situation is different, and every client and every investor is different in what they're trying to accomplish.
Everybody's different. Every deal we've worked on has been different. Everybody's got a different story, a different goal of what they want to do. Pass it to the kids, don't pass it to the kids. They can kind of handle themselves. We've kind of heard it all. But we love this conversation. We do presentations, all around the U.S. We do tons of webinars on this stuff also. And it's such a powerful tool. A lot of CPAs actually don't know about this stuff, and we educate a lot of CPA firms, law firms, real estate brokerages, and it can be an incredible prospecting tool for real estate professionals, but also just a great value add. for the CPAs and the attorneys out there. So if you guys have any questions at all, send them in to us. We're going to be addressing questions on future episodes. Maybe we'll go through some case studies, on some future ones as well. But yeah, I mean, this is something that's so powerful. If you're if you're thinking about investing in real estate, or you own investment properties and you don't know about the 1031 exchange, you got to get up to speed on that.
Yeah, definitely a tool in the tool belt. Absolutely, 100% tool in the tool belt. Not a fit for everybody, not a fit for every sale, but should definitely be a part of the things that you evaluate as you invest, as you grow, as you liquidate.
Well, guys, thank you so much for listening today to our podcast. Make sure to like and subscribe. Leave us a 5-star review, please. If this was helpful and you guys have any questions, send them in to us and we'll address them on future podcasts.